Hey, what's going on, my friends? It's your man, Adam Ace Spencer, here with another M1 Finance Growth Portfolio Update. If you're new to this channel, we are contributing $5 every weekday or $25 a week into this portfolio. I'm not intending on using any of this money over the next 2 years, 3 years. So, regardless of how the market is doing, and by market, I mean the stock market, how the economy as a whole is doing, I am going to continue to contribute money into this portfolio. Now, a lot of you guys out there might be starting to hear more and more stories about a recession or about how bad the stock market is doing. Well, it's true. As you guys can see from the title of this article, after stock market's worst start in 50 years, some see more pain ahead. It can be very discouraging and a little bit scary, I would say, too, knowing that we are doing worse, literally worse than the past 50 any point over the past 50 years to start off 2022. If I dive into this section here of the article, it says the 6 months through Thursday were the stock market's worst first half of a year since 1970. The S&P 500, the cornerstone of many stock portfolios and retirement accounts, peaked in early January and has dropped nearly 21% over the past 6 months. In other words, the market is doing horrible and pretty much every portfolio is doing bad. Every stock is pretty much down. I don't think you're really going to find many plays out there that are safe during this type of economy with the stock market performing so badly. All of that said, I do want to dive into the portfolio and let you guys see right off the rip. We'll do our regular update in a moment, but I want to show you my plans to kind of readjust my portfolio in terms of how I'm allocating my funds and what the target percentage is of this pie of our portfolio that we want each stock. And before, it was essentially pretty even. You got the equalize button here that will make everything pretty much even across the board, and that's essentially what we did before the first time around. But because of the way the stock market is performing, how iffy things are going to be for the next year, potentially 2 years, maybe longer, maybe less, but you just don't really know. And I would rather readjust my portfolio to really align with the stocks that I believe will perform best over time, and that have a more sense of security and are more proven. And just again, that security part is very important because this is a growth portfolio. I expect it to be risky, and I expect it to be volatile. Again, it's a growth portfolio. That said, I do want to protect as much of my money as possible. So I decided to readjust my target price point for each stock in here. And you can see at the top 16% of our portfolio, or a pie, will be Nvita, or Navita, as I like to say. And after that, I have SEM Rush, SEM Rush at 15%. And then I have ChargePoint at 14%, followed by Palantir at 13%. Then, keeping it moving, you got CleanSpark down here at 12%, and we got DraftKings here at 11%, followed by Coinbase at 10%, and at the bottom, Backed Holdings. Now, again, it's the way I'm approaching it is just I want to take more of a I guess, again, that security, the comfort aspect of it being less risky. So at the bottom, you pretty much are seeing all of the cryptocurrency stocks at the bottom of this list. Backed Holdings is 9, Coinbase is 10, and that's pretty much it. I mean, yes, you can say like CleanSpark, but and they're at 12. So I mean, DraftKings is at 11, but I wanted to put CleanSpark over DraftKings because of the energy element of their business model and whatnot. And so, yeah, and then I put DraftKings above most of the other ones simply because I do believe the aspect of them continuing to make progress on a state level, individual state level, with getting more of their services out there and whatnot, their business out there. I do think DraftKings is continuing to make pretty good progress as well. cryptocurrency just has a big target, I feel like, on it. And it's an easy target because it's so mainstream and so popular. So all these crypto stocks, I feel like, have been hit the hardest for reasons like that. All of that said, I do want to continue to invest money in all of them. I will continue to, grow this portfolio with these more volatile plays. And part of the reason is because the ones that are more risky, more volatile, oftentimes tend to be more rewarding when it pays off. Again, when it pays off. Or if, I should say, let me rephrase, if it pays off, because it doesn't always, hence it being so risky. So I'm going to press continue up here because I like the way everything looks. We're going to update it, 9%, everything looks good. And we now have a updated portfolio here inside of M1 Finance. So as you guys can see over the past day, jumping right into it, of course, we are up 0.22%. Over the past week, however, we're down 14.65%. Over the past month, we're down 9%. Over the past quarter, we're down 43.20%. In 1 year, which is the same as all time, our portfolio is down 62.54%. Oof, so brutal. So brutal. But as you guys can see, our current value stands at $933.93, which is a gain of negative $794.88. So our net cash flow, as you can see, the total amount that we've essentially deposited is $1,728.88. So we're down quite a bit. We are down quite a bit, which is comparable to pretty much every stock out there, every portfolio that is that exists these days, because the market has just been so brutal, as we just touched on with the New York Times article. So you got to be mindful that no portfolio is really performing well. The whole stock market is getting beat down pretty badly. And when we look at our portfolio to see who's doing well, who's not doing so hot, you can see we got ChargePoint at the top of our list, who is down only 6.31%, followed by SEM Rush, down 11.93%. Then it drops down quite a bit, going to Nvidia, down 44.96%. Then Palantir, down 55.27%. CleanSpark, down 62.29%. DraftKings, down 63.94%. Backed Holdings, down 73.74%. And Coinbase, down 89.67%. Yeah, a lot of red, very bloody. And this is expected during a recession, essentially, when the stock market is performing so bad and you are again basically in a recession, on the verge of being in one, or as some are saying, we are already in it. Well, you can't really expect your growth plays to be killing it, but you can expect this to be the opportunity for you to kill it by acquiring as many shares as possible while they are cheap, with the hope, with the belief that the stock price will go drastically higher over the next year or two. And that's exactly what I believe with this portfolio and the stocks that you guys are looking at here on the screen right now. So my plan hasn't changed despite the news that continues to come out about how bad the market, the stock market is doing, and how bad it may potentially continue to perform this year. I'm going to continue with our dollar cost averaging strategy approach, investing $5 every weekday, $25 a week into this portfolio, and just continue to accumulate as many shares as possible. So when they run, well, we're going to have a nice big bag that we've been holding on that will end up paying off for us because of our patience and the appropriate, due diligence, the research that we've spent. And again, not getting, those weak hands, holding on, right? Diamond hands, baby. You got to hold on to what you believe in and just keep acquiring more shares when you can. And considering every stock is pretty much down, the market's doing pretty bad. That means if you believe these companies are going to be around and be doing better than where they currently are today, in a year from now, and 3 years from now, and 5 years from now, well, you should consider acquiring, buying the stocks from those companies as well, and just holding. Be patient, hold, and hold if the market continues to go down, well, yeah, you can cut your loss. At some point, you might say, you know what, it's not worth it. Or you might be able to time it and say, I think it's going to drop a bit more and pick up in July. Well, when July comes around, it might potentially go lower. Maybe it doesn't. Maybe you did time it perfectly. But that's just hard to do. And it's very time consuming because you got to watch the stock market every day, every little movement. It ain't worth it to me. I would just rather invest $5 every day or $25 a week, regardless of how good or bad the stock market's doing. And that way, like I said, when the market does reverse and rebound, well, I'm going to have a lot more shares than what I would have had if I just stopped buying altogether. Or potentially if I try to time it where maybe I timed it at the worst time and then things just drop even more. I have no money to throw at it because I threw all my money at it at that one time. So, hey, yeah, the market's not doing so hot right now, and your portfolio most likely isn't as well. It might look similar to our portfolio over here. So don't be discouraged. Stay true to your plan. Hopefully you have a plan. And ultimately, like I said, look at this as a great opportunity to buy as many shares as possible at a reduced rate, at a cheaper price, and then just hold. Be patient and hold, and know what you're working with, know what you're holding, and it will make it that much easier, regardless of how much worse the market gets. So, my friends, I'm going to wrap it up there. Feel free to leave a comment down below with your thoughts about my portfolio, or how is your portfolio going? How is your portfolio doing? And yeah, of course, while you're down below, smash that like button and subscribe to the channel. Hit that notification bell so you guys can stay up to date on all of our latest and upcoming video content. But all right, my friends, much appreciation for watching. But you already know what it is. I gotta keep it moving. But I'll see you in the next video. Peace.